Joining us for the very next hour is our market timer, Tom McClellan. He's editor of the family-run McClellan Market Report. Last year, he was named the #1 long-term market timer by Timers Digest. Welcome, Tom, to Street Smart. It's a pleasure to have you here.
Oh, it's good to be here in New York.
We were just talking a little earlier. You're pretty concerned about things right now. You say the market's about to hit a correction.
Well, the market's been in a corrective mode starting in February that's due to last until June. The market just doesn't know it yet. And it's continued on higher even without any support. And so what goes up without any support is going to have to come back down to get itself just back on track.
What about the idea that there's all this money that's sitting on the sidelines, and as they see all these good economic reports come out, whether that be a jobs report, whether that be, well, I can't point to manufacturing or durable goods
Not today anyway. No.
But, you know, we have seen a lot of positive data. Is any of that going to start to add up to any momentum there for the market?
The money that sits on the sidelines is kind of a misnomer. Everybody talks about that, but I like to pose a rhetorical question to people. How much money is in the stock market? And I let them think for a minute, and then I point out that, you know, if you put money into the stock market right now, it immediately comes out the other side into somebody else's hands. So there is no money in the stock market. It's all just a question of how much do people want to pay, how much money they have readily available that they can get their hands on to try to trade with. And we're in a period right now where that's gone down a little bit, and people just don't know it yet.
Hey, talk about going down. You have created a little chart. This is like a little chart attack, but we're giving you a tease. This one comes early. We got two chart attacks today. And, Tom, what you're really doing is calling this a sugar-free rallying effect. It's the rate of change of the balance sheet for both the ECB and the Fed over 3 months versus the S&P 500. And what we've seen is that as the balance sheets got bigger, the market went up.
Sure.
And now all of a sudden, look at what's happening on the far right side of that chart. You've got the balance sheets getting smaller, and yet the market's going up. And maybe that's what you're getting at, right?
Exactly. When the Fed and the ECB are creating new money and pumping new money into the banking system, what they get in return is bonds that they put on their balance sheet. And so they report that data all the time, and you can analyze it. When their balance sheets are growing, there's more money available to lift stocks up. And so, not surprisingly, there's a great correlation. You get into a problem when the market goes up without that kind of monetary backing. And we had that problem.
Why is that a problem? I mean, I would actually say, you know, if you've got a market that's going up because people fundamentally believe the economy is better, as opposed to, you know, the sugar high, we need more of a fix from Ben Bernanke and company, I'd say that's kind of a good sign. You want the market going up without the intervention of the Fed.
Well, but you're talking about whether the market has real backing or whether it's just on people's feelings. I'd like to say that there's only two fundamental factors for the overall stock market that matter. Forget earnings, forget dividend yield, forget book value, forget all that. The only two factors that matter is how much money is there and how much does that money want to be invested. Now, if people suddenly become more willing to be invested, but there's not the money to back it up, people are fickle, and they can get unwilling to invest really quickly to get back on track.
They sure can.